Premium and discount pricing, it's a pretty simple concept, to be honest, and not something that we need to, overcomplicate unnecessarily. But it can be, pretty powerful when we use it as a piece of confluence to combine with everything else that we use. Now, when you get towards sort of the end of all of the modules and the technical analysis part of the course, right, and we start to put trade plans together, you see the strategy as a whole. This particular confluence, so premium discount pricing, it probably sits at the bottom of the pile in terms of importance for me, in terms of what I look for. It's kind of the last thing I sort of consider, as a piece of evidence for or against a specific trade idea. But that said, it still is something that's very, very powerful and can really help us to boost our strike rate and also risk to reward for knowing how far to really push trades that you may be in with your targets, etc. So without further ado, let's just dive into it. Nice, simple bullish market structure here on the left-hand side, right? Hopefully we should be very familiar with that now, with price making a series of higher highs and higher lows. Now, this tool here, this sort of rectangle, right? What you do, I'll show you how to draw in a minute, but essentially it's a Fibonacci retracement tool where you draw it from the low to the high, okay? So whatever piece of structure you're looking at, you draw it from in the bullish market, right? You want to draw it between that high and that low of that price leg. And essentially what it does is it just draws a nice little dashed line halfway down that leg, which is the 50% level, the EQ, the equilibrium, right? That's what we call it. So if you open this up, it's just a Fibonacci retracement. Fortunately, the way I've done the recording, you can't see the left-hand side of the toolbar, but if you move your mouse to around the third one down, and then you click on here, the Fibonacci retracement, that's all it is, okay? And what it looks like is when you draw it from a low to a high, is you'll get something like that once you have the settings that I use in there. Obviously, you'll have something that probably looks horrible if you're using it for the first time. So what you need to do is use these settings here that I have, okay? So pause the video here and you can remake this. I don't, 0, 1 and 0.5 is all I have on. And you can play around with the background color nice and down just to make it a little bit more visually appealing. So yeah, that's all that tool does, is it just shows you basically the halfway point. And the reason why, or the way we look at it, is essentially anything in the top half of this, we say is the premium. So that's where prices are expensive. The halfway point is the equilibrium. So the EQ, we call it, essentially the 50% of the pullback. And anything below that is the discount. Okay, so this is where we have cheap prices. So obviously when we're at the top, if you say, this is say one certain price and this is one certain price, these are going to be the more expensive prices and these are going to be the more cheap prices, right? So what typically happens in a bullish market is you get that leg up, and then as we start to pull back, you can draw on your premium and discount pricing, and price will typically pull back down to those discount prices. It will pull down to the cheap prices. This is where people are going to go, okay, now this currency pair or whatever instrument you're looking at is now at a cheap value. It's at discounted prices. So it increases the probability that people are going to want to buy this up, right? At cheaper prices, there are more demand for a product, right? At more expensive prices, at more premium prices, people tend to sell more at those prices, right? And that's basically it is, right? Buy low and sell high. And that's what this tool helps us to do. So in a bullish market, price will typically pull back to discount pricing. It does not have to, but that will be where it's more likely to, or where I should more accurately say, the higher probability is to be looking to buy down in here. And then we can, again, target the weak high. We then get that next break of structure. And as we start pulling back, we can draw on our premium and discount tool, and we can start to look for price to pull back below that EQ line to around the equilibrium prices, or down into around the discount. Okay. And then again, it's higher probability to then to be looking for those longs to target the weak high, so on and so forth. But remember, like I said, price does not have to pull down here. So if you're always waiting for price to pull down below the EQ, right, down into discount pricing, you're not going to catch every move, okay? And that's just part of the probabilities of trading, right? And then likewise, in a bearish market, exact same way. So you just draw it from the low to the high, or the high to the low, whatever way, doesn't really matter. And then typically what we expect for the high probable moves would be that price will pull back above the EQ of this to premium, okay? So it's just the opposite, right? When we're buying, we want to buy cheap, we want to buy in the discount, right? We want to be buying below the EQ, below the equilibrium. When we're selling, we want to be selling at high prices, right? Ideally, we don't want to be selling low, we want to be selling high, right? We want to be selling the premium and then targeting the weak low, okay? I think it's quite a basic concept, so hopefully you guys will get it. Again, we get the break of structure. We can then, as we start to get our pullback, we can then apply the premium at discount to that and, run with the trade idea that we are more likely to pull up to the premium prices, or actually what should be more of an accurate statement would be that selling in the premium would be higher probability, okay? So on and so forth. Now, here's just a bit more of a detailed sort of price action example where we initially get that big bullish break of structure. So in this case, that swing break of structure. And then as we start to pull back, we can obviously draw on our swing high. And this is just the same tool that we were just looking at, but I've just, instead of just having it on the price leg like this, I've dragged it across just for it a little bit more easier for visualization purposes. Okay, so when you know the swing range that you're currently in, this being your swing low and this being your swing high, what do we know? Well, we know that the swing range is bullish. We know that this orange line here is where the swing low is, and this is our strong and protected swing low because it took out the weak high, right? So when we start to have that swing pullback, we can run with the expectation that the strong low will hold, it will be protected, and price will not break it, okay? Now, we can also, want to be looking for trade ideas to trade the swing pullback, whether we want to short the pullback and then we want to try and catch that high low to try and catch that next swing run, okay? And this is just where this premium at discount pricing can become a decent tool, because as you can see here, right, everything above the EQ of this swing leg, so this is the leg we measure, right? Everything above that EQ is what we call premium pricing, okay? This is where, I guess, an easier way to think about it is where prices could be deemed or viewed as expensive, right? So this is where if you want to short and if you want to play the pullback, it's going to be higher probability to do so when we're in the premium pricing. And then if you want to start to get long and start to buy, it's going to be higher probability below the equilibrium, right? Where it's fair value, you want to be buying somewhere within the discount where those cheaper prices are. Okay, so again, let's talk through this. We have that break of structure. We know at some point we have to start to expect that swing pullback maybe kicking in. Let's say we get an internal break of structure, so the internal structure now shifts bearish, right? That is then a good signal that we can start to look to short to play the swing pullback, okay? Now, the whole time we know the swing trend is bullish, we're looking for that swing high low to form, and then what do we see? Then we see a bullish internal break of structure there. Okay, that can now signal that potentially the swing pullback, right, has now finished, and now potentially we're ready to target the weak swing high, and we can start to look for longs, and we can start to buy these internal high lows to try and target that high, right? That's absolutely fine. What can happen, not always, but what can happen is because this happened, this shift in the internal structure, it happened in the premium pricing, as in price has not yet pulled back to the discount. Not always, but it can, decrease the probability that this is going to be the swing high low, okay? So although I am happy that if we get those internal breaks of structure, I'm personally in most cases, right, happy to start to look for longs. I'm just always aware in the back of my mind that, okay, we haven't pulled back to the discount pricing yet, so maybe this is a full signal. And obviously in this particular example it is, because then the strong internal low here, the high low, it's strong, right, because it broke this high. So the expectation would be that it would hold, but it ends up failing. The internal structure then shifts bearish here. So that at this point, it would go, okay, maybe now the swing pullback, actually it isn't over, maybe it's resuming now and it's going to continue down, right? And then that's where you can follow the bearish internal structure to the downside. So maybe you want to look to short this as well. Now, whilst the internal structure is still bearish and we've pulled down into the discount of this swing leg, right? Into the discount prices of the swing leg, you have to start being very wary now that there's an increased probability that the swing high-low is going to form because we're now in cheap prices, and there's an increased probability that the internal structure is going to shift bullish, right? So you can follow the internal structure. Now, it depends on you how much confidence you want to wait for, whether you want to start getting long straight away or whether you want to wait for the internal structure to shift bullish, all of these things. We'll get into that at a later point, okay? For how you want to be as a trader and what confirmations you want to wait for. For now, just think about this is just a piece of confluence and it's just probabilities. That's all I want you to understand at this moment. And that once we pull back into the discount, shorting against the swing trend is becoming lower probability. Following, this internal structure, like, because obviously if you're shorting, you're trading in line with the internal because the internal is bearish, but you're trading against the swing trend, right? Because the swing trend is bullish, because they're misaligned, right? The swing is bullish, the internal is bearish. So you can follow the internal up here, right? And you can look to short these highs, but it's going to be higher probability to short against the swing trend when you're in those premium prices. As we come down into the discount, I think you guys are getting it right. It's becoming lower probability. So then when we shift bullish, okay, Now, when price is pulling back into this strong internal low that took out the high, trying to buy this high low, this internal high low, anticipating that it's going to be the swing high low, is a lot higher probability than when we did it up here, right? Because this was in premium, this is in discount, right? So yeah, I think you guys get it. Now it's high probability to try and target that weak swing high, because it's, yeah, a much higher probability that the swing high low is going to be in place. So the last example we're going to look at, kind of just to drive this point home, it's pretty much the exact same sort of line diagram we just looked at. I've moved the premium and discount of this whole range, just moved it over to the side just to keep it a little bit more minimal. And that's probably what I'd recommend when you're doing this in a live market as well, because as we start to overlay more and more confluence and concepts that you guys are going to learn, we want to keep our charts looking as clear as possible so we can actually focus on price action and we don't just get, lost in a cloud of, drawings. So yeah, let's keep it nice and simple, right? We have a bullish market, we have that swing breaker structure to the upside, and then eventually we get either a bearish IBOS or potentially it could be just a change of character, okay? And now this is something I didn't mention before, but in the market, I mean, you might have already noticed this, right? Especially if you're a bit more experienced. You're not always going to get these picture perfect, sort of picture perfect nice swings in the market, right? Where we get clear internal structure, a nice big internal structure within a large swing range. Sometimes it's going to be like that, and you've seen those examples in the previous lessons and walkthroughs. Sometimes it's a bit of a tighter swing range, and you can get just just fractal pullbacks, and we just look for change of character, and we're not always going to get that nice and clear, obvious IBOS, right? So if anyone was wondering, yes, you can also view this as a chalk rather than IBOS. The same concept applies, okay? But again, that will become clearer as we dive into more price action examples. So we have that swing breaker structure. Let's just call it internal structure to keep it nice and simple. The internal structure then shifts bearish. Where are we at this point where we switch bearish? Well, we're still within the premium of the swing range, right? We're above the EQ. So we're within the premium of the swing range. We have not yet pulled back down to discount pricing. So actually, if you want to short and you're happy to trade counter trend, this can be the time in which it can be viewed as high probability to do so, right? Now, as you can also see here, I've also drawn on the premium and discount of the internal leg, right? So you can apply the premium discount concepts to any piece of structure that you want. You just have to be aware of what range you are within and where, right? So in this moment, we are within the premium prices of the swing range, okay? We have that internal breaker structure. So now that is a very good signal that the swing pullback is going to start, right? So we can anticipate, or we can look to target that price is going to pull back down into the discount of the swing range, right? That's what we would think from a swing range perspective. So now if we want to trade this internal structure and we want to short it, once we get that internal breaker structure, this becomes that strong internal high. So we can wait for that internal pullback and we can wait for it to come up into the premium prices of this internal leg, right? It's just another concept to help us try and not short here, but wait for the pullback to a level in which it's more likely to form that internal lower high, right? So we don't get stopped out prematurely trying to sell down here. We wait for the pullback to the premium prices of this internal leg, right, above the EQ. Now it's higher probability to try and catch that internal lower high, and then we can look to target the swing pullback, right? So, I would recommend mainly targeting those weak lows, right? Those weak internal lows, because although, there's a decent probability that price may want to pull back to the discount of the swing leg, it doesn't have to. And when you're shorting here, you have to remember you are shorting against the swing trend, and the swing trend is the most important. It's the most powerful. So it's not always going to be perfect where you get those nice deep pullbacks down into the discount. Sometimes you could look to trade this short. You could target the weak low, right? But then you might want to hold on to a lot of your running volume to try and target down here. But then actually the pro trend swing move kicks in, and then you can take a break even or a loss. So when you're trading counter trend and you're trading these moves, you want to be a little bit more aggressive with your management, okay? Now, I know we're probably getting a little bit ahead of ourselves here thinking about trade management, and we'll talk about that a lot later in the course, but just something to get your mind thinking about, okay? And that's it, really. We want to ideally be playing those counter trend shorts when the swing trend is bullish. We want to be doing that in the premium of the swing range, and then obviously we can follow the internal structure, and we can look for that to pull into the premium of the internal leg, all right, and so on and so forth. But then as we get below this EQ, you need to really start thinking that the probability of the swing high low forming and of the internal structure shifting bullish is becoming a lot more higher probability. And then likewise, we get that bullish internal breaker structure. You can look for it to pull back below the discount, right? And then we can look for those moves. Now, again, you don't have to have it in your plan that price has to be in the discount of the swing or of the internal. It's just another tool to help you increase the probability of where those turning points are most likely going to form, okay? Now, another key point here actually that I'll end this lesson on that will really come in useful as you guys start to get a bit more advanced is that so obviously what I said, right, is that we want to ideally we want to be buying in discount prices, okay? So up here, or actually if I go back to the previous example. So over in this example, right, remember how we were in the premium of the swing range. This has all been the premium pricing. And when the internal structure shifted bullish here, okay, it's, we said it's slightly lower probability to be buying here just because we haven't yet pulled back to the discount, right? And we're aware of that. But over here, let's say when price is pulling back and you want to buy here, yes, it's still in the premium pricing, so it's not ideal, all right? Obviously, we want to be buying low, but I would view this, all those things, being considered equal, I would view this as a high probable area to keep buying because price has already pulled back to the discount. Okay, so what that means is there's an increased probability that swing pullback is ended, and we are going to go and continue to form that swing high and target the weak swing high. Okay, so let me try and make that point again. Is you could write on paper, say on your trade plan, that you never want to buy in premium prices, and whilst that could be a good rule, there's a slight difference between buying here, right, where we haven't yet pulled back to the discount, and then buying here when we already have pulled back. And the difference is that when we've already pulled back, what are the odds, right, when we start moving up here, that price is going to come back down, right? We've already, come down, we've filled those prices. Now, when the internal structure shifts bullish, we expect that it will stay bullish until it takes out that high. So that's why we can keep following these internal high lows until we take out that high. Again, it's just probabilities, it's not a guarantee, but that's where in this instance, I'm happy to keep buying at the premium once we've had that pullback to the discount prices and we keep moving up. Rather than over here, I'd be a lot more cautious of buying here because we haven't yet pulled back down to kind of fill those discount prices at the cheap level, okay? So that's something that can really help you when price action get a bit more complex in a live market, of knowing when you want to be aggressive, when you want to kind of, keep following this at the premium prices, even though, your risk to reward is diminishing because you only want to be targeting this high, because what do we expect after break of structure? We expect that pullback, but you can look for, a quick move into here. Potentially there's enough risk to reward for you, et cetera, et cetera. But it's more just a case of, this is a different move to this one in most cases once we've already pulled back, okay? So reasonably simple tool. You can obviously, use it in more complex scenarios like I just spoke about there at the end. But essentially all we want to be doing is buying low and selling high for the most part. And this is one tool that can help you to do that. So let's take a look at some examples on the charts.